Good afternoon, everyone. Good afternoon from Manila, and welcome to the latest Asian Impact webinar from the Asian Development Bank. Let me ask you a question. Who here has not heard of Indonesia's Gojek or Airbnb or Elon Musk's SpaceX or Grab? The last three belong to the highest valued tech startups in the world, with valuations of 30 billion, 19 billion, and 14 billion US dollars respectively. All startups started small and faced almost similar problems in acquiring finance before they could get bigger and be successful. In today's Asian Impact webinar, we will ask what can be done to kickstart equity financing for tech startups in Asia. And can the region attract its share of patient financing like venture capital? My name is Amy Hampel, and I am an economist at the Asian Development Bank. Together with Paul Vandenberg, senior economist at the ADB, we are the project team leaders of ADB's Financing for Tech Startup study, and we are happy to discuss our work with you. We are privileged to have with us 4 distinguished panelists who will complete our lively debate this afternoon. I will be introducing each one of our distinguished panelists shortly before they speak. I'd like to remind everyone that we will hold a question and answer panel afterwards, and we want to make this a really lively discussion. I'll kick off with a few questions after the presentation, but we would like to hear from you, our audience. Please type your questions into the Q&A box, which you can find at the right side or at the bottom of your screen. Please do give the thumbs up sign or like the existing questions, and we will address the most popular questions first. All right, I'd like to introduce you to Mr. Paul Vandenberg, a senior economist in ADB's research department and the studies project team leader. Paul would walk you through our study and pose some thought-provoking statements to our panelists and to our audience as well. Let me give the floor now to Paul for his presentation.
Okay, thank you, Amy. Glad to be here. Let me just say, I'm not going to run through our study, but what I'm going to do is this. I'm going to give a couple of observations. That's been the first part of my presentation, and then get into policy issues. And these policy issues are ones that I hope our panelists can pick up on, and we'd really like to hear their opinions. Okay, so starting off, we're going to talk about financing of tech startups. Can I have the next slide, please? So we situate startups usually in what we call an ecosystem. And I think if we asked 10 startup specialists or experts to draw an ecosystem diagram, there would be 10 different diagrams. So there's no agreement on what should be included, but I'm pretty sure that all 10 of them would include finance, and all 10 of them would say finance is an important part of that ecosystem. Next slide, please. When we think of financing and we think of tech startups, we tend to think of certain sources of financing, things like venture capital, angel investors, sometimes incubators and accelerators if they have a finance program, and crowdfunding as well. We often also think about pitches and pitch competitions. You know, this is where they bring their idea and they get financed either by winning the prize and they put it back into their business, or they've attracted some investor from the audience who wants to fund them. So that's another source of financing. Now, we've done some work on these things, and there's 2 things that has kind of struck me about financing of tech startups that I want to talk about. And one of them is that the range of financing options, or the range of types of financing, is quite broad. Okay, so it's not just that there's venture capital and they either get it or they don't. There's a variety of sources out there. And I think to understand finance and tech startups, we need to think about the range of sources. That's one. The second observation is that, and I think this is the more interesting observation, is that if we think about the common sources of tech startup financing that we think about, angel investors, venture capital, they're in fact not the most common sources of financing. Okay, and that sounds a bit counterintuitive. Next slide, please. So if we look at a couple of countries, Cambodia and India, for example, we find that the most important or the most frequently used source of financing is not venture capital. Cambodia, it's self-financing. That's from savings and salaries of the entrepreneurs from possibly other work. Third most important is family and friends. And then after that, we get the angel investors and the venture capital and so on. Okay, if we look at India, we have a slightly different picture because this graph shows only external sources of financing. So it doesn't include personal financing, which would be the most important. But even here, we find that family and friends is the top and by far the most common source of financing of startups. And after that, we get things like angel investors and incubators, which is, I think, kind of interesting. Now, part of what you might say is, well, these are developing countries and maybe their financing systems are not so developed yet, right? And I think we certainly can say that about Cambodia and maybe less so, but still might be relevant for India. But let's look at our next slide. This is the United States, and we find the same pattern. Personal savings and credit is by far the most important source, followed by family and friends. And then after that, we get venture capital, angels, and down at the bottom, crowdfunding. And this is interesting because this is not the frequency or the types, the number of times that an enterprises get financed. This is actual total amounts of money. And by far, personal savings and credit is the most important. So those are some of the interesting things that we found. So the range of sources and the fact that some of the common sources we think about are not actually the ones that are most used by enterprises. Okay, those are a couple of observations. Now I'd like to sort of turn to the policy issues. Next slide, please. Okay, so if we assume that tech startups don't have access to enough finance and that we need to have more finance, we ask the question, well, how should that come about? What should be done? Now, part of the way you could answer this question is you could say, well, this is a private sector issue, right? These are private sector enterprises, and it's up to private sector investors through venture capital, through angel investors to come forward and to provide financing. So we could leave it to the private sector, and that might work, but it might be insufficient or it might take too long. Right, and so that's one possibility. But the other possibility, of course, is that the government has a role to play. Tech startups are important for an economy, and the government should take an active role in trying to provide them. If we assume that, then we start to ask, well, what kind of role should they take, right? And this is, again, an important question for our panelists, and I hope they can talk about this. Some of what we find is that governments directly are involved in financing. They set up their own venture capital funds, right? We're looking at one country now, and there's no venture capital in the country, and the government has decided to set up its own venture capital fund, right? Or it may do kind of a similar thing, doesn't set up a fund, but it puts money into an existing venture capital fund to increase the pool of financing, right? There are other possibilities, such as grants for innovation. We talked to enterprises in Thailand and India, and this came up quite frequently. A number of them had sourced those kinds of grants from government, and there may be other sources. Or we could say, no, the government shouldn't be a financer, but the government should be a facilitator. It should create the environment for venture capital, for angel investors to invest, tax incentives for angels or investors into venture capital so that, when they reap the returns of selling out of their equity, it's not taxed too high, and so on. Also to encourage corporate venture capital, because we find a lot of corporate venture capital. These are large companies setting up venture capital funds and doing it that way. So that's some of the possibilities. Next slide. The other question we kind of have to ask is the quantity of funds available the real barrier? Okay, so it could be that there's a lot of venture capital or other sources of funding that wants to invest in startups, but there are barriers to getting it to the startups. Okay, and I think we have to think carefully about that, because that could be the situation. The amount of money may not be a problem, it may be there, but it's channeling it to startups. Now, why might there be barriers? One of the things that we found, I think Amy particularly found this in Vietnam, is that the startups have to present themselves. They have to pitch. You know, it could be a private pitch, it could be a public pitch, and they're not very good at it, right? And so if they're not very good at it, they can't convey their idea well, and therefore funders are going to say, well, you know, that's not really clear what that idea is. I'm not really sure that's going to work. So maybe the solution is not providing more funding. It's teaching enterprises better how to pitch. And we know this from our work on small and medium enterprises. A common issue is they don't get enough finance, and you talk to banks and the banks often say, yeah, but they don't come forward with good enough proposals for us to finance. So that could be a common thing. Perception may also be another thing. Amy, and again, particularly has found this in some of the countries she's studied, that the startups are perceived to be similar to SMEs, traditional SMEs, and that doesn't sort of help in the process. The other thing that we found, and we sort of found, but you know, we have debates about this, is that there needs to be a good environment, not specifically it needs to be a good environment for the angels and the venture capital, but it's also important that there be a good regulatory environment for the startups, okay? And the way this works is that sometimes you have venture capital that's regional venture capital, and it's looking like in Singapore, for example, and it's looking to fund enterprises in neighboring countries, but they don't want to, or they're hesitant because the regulatory environment for the enterprises in those countries is not adequate, right? There's not clear tax rules. There are not clear rules about divestment. There's not clear rules about bankruptcy. And because of that weak institutional environment for startups, venture capital is a bit hesitant. I'm going to leave it there. Those are some ideas, and I'd be very interested to hear what the panelists might think and say about these. Thank you very much.
Thank you very much, Paul. I am very interested now to hear what Winston has to say, because Winston has hands-on experience in venture capital. Our panelist is Mr. Winston Damarilio, Chief Strategy Officer of Unawa. And Unawa is a tech startup winner of ADB's hashtag Digital Against COVID-19 Challenge on hard-hit economic sectors. He is a Silicon Valley veteran with over 20 years of experience as a technology entrepreneur and venture capital professional. And he has investments which has resulted in successful IPOs or profitable corporate acquisition. So is the problem, Winston, not the availability of venture capital, but the enabling environment? What can you say about this?
Well, thank you, Amy. And Paul, thank you very much for setting up the stage. I've actually been kind of circling around this journey several times now, right? So I started very early on as a venture capitalist at Intel Corporation. We felt like this was the early days of Sand Hill Road in Menlo Park, when venture capital was really there for extremely innovative technical ideas that wouldn't get funding because it was too technical, and it needed the Intels, the HPs, and the predecessors of Google to do that. And we built Intel Capital to do that, and grew it to about $1 billion a year of investments, over 300 professionals. So coming from that background, I have had the opportunity to both build and raise money in Silicon Valley for 3 of my startups, and have exited those. And I think at a period of time when those were done, I was really pointing out to how could you replicate Silicon Valley, or how can you adapt a model of financing out from Silicon Valley and into emerging countries. And I've been spending a lot of my time here in the Philippines since then. A personal journey for us, we built a startup called Unawa. It's a regtech company that's intended to ease doing business here in the Philippines. And we were very fortunate to be mentored by Amy and the ADB team through our participation in the challenge. have won the challenge. We used that challenge as a springboard to actually initiate our fundraising. I don't know, Amy, if you know this, but since a couple of months after winning the award, we've got a signed term sheet now with the local angel group, oversubscribed and did really well. And about to announce that shortly, right? So we kind of did our own journey here from the ground, from the idea stage to a challenge stage, and I might say we're trying to engage all the mechanisms that we have. So that's a journey of Onawa, and now we're about to kind of launch the company post seed funding. There are a lot of differences and similarities, and there are a lot of mechanisms now for funding that's really interesting to follow. I myself is a venture builder, so I'm an investor who builds companies always in tandem with a corporate venture partner or with a large corporation to build a hybrid of an idea from the streets combined with a market leader conglomerate in emerging countries like the Philippines. And there's a model we're beginning to form in that model of financing. I have also been working with the Middle East in the sovereign wealth funds of the Middle East, and shortly we'll announce a build-up of a new bank in the Middle East in a different kind of financing model where governments are actively involved, right? In Bahrain, as an example, not only did they set aside capital to encourage venture capitalists to come to Bahrain, they actually built a $100 million fund of funds called Al Waha to act as a counterpart investor for any VCs that will participate in their market. So I did that. We ended up raising a fairly good amount of Series A funding, and this is a way to attract new entrants into an emerging or a new territory. In Bahrain, for instance, it's fairly nascent in that model. And then now, since COVID, I've been back in the US. I'm spending a lot of my time building startups here as well. And the tool for finance has evolved dramatically from Menlo Park and Sand Hill Road's early days. Crowdfunding has gone beyond Kickstarter, and it's now really a formalized equity crowdfunding because of the Jobs Act in the United States. And I think that chart you showed earlier, Paul, might evolve dramatically, where there's going to be a big shift from venture funding and friends and family into a formalized small investing through the Jobs Act, the CF, the Reg A+ models here. I think it's the one that may be highly adaptable to emerging countries. So there's a lot of innovation in the financing space, I guess, is the short of all of that statement. And it's very encouraging, very exciting. And I think there's now a global model, right? No longer just Sand Hill replicated everywhere else. That could happen, and I think our startup journeys, post pandemic, is gonna be interesting, and I'm highly optimistic about it.
Thank you, Winston. This is getting more and more interesting. I'd like to ask our next panelist. Winston said that the model he uses is he's always in tandem with corporate VCs. And also that the government, if the government gets involved, such as in Bahrain, you get a serious amount of funding for your startup. What do you think about this? Katrina is our next panelist. She's the director of the QBO Innovation Hub Philippines, the Associate Director of Idea Space Foundation. QBO is the Philippines' first public partnership platform for Filipino startups created through the collaboration of Idea Space, JP Morgan, the Philippine Department of Science and Technology, and the Department of Trade and Industry. So what do you think, Katrina? Can we do that? Can we replicate this in the Philippines?
Hi, Amy. Yes, thanks for that question and that introduction, and good afternoon to everyone. So yeah, as you mentioned, at Kubo, we actually kind of tried this collaborative model, right? Like that was the whole genesis of the concept, is that people would in some ways, like risk would be shared, right, among different parties, and that there would be more players that would want to engage with startups. So definitely it's a model that we would want to aspire to, right? That we would be able to also achieve similar gains in the Philippines. So, the very formation of Kubo is sort of dependent on this public-private model, and we deliver both direct interventions to help startups, but also have initiatives to improve the overall enabling environment. We've had some modest success, right, with the passage of the Innovative Startup Act, for example, also supporting other incubators, right, and other accelerators, as well as generally, promoting our startup ecosystem and kind of marketing, attracting talent to the ecosystem, right, as some of the things that we do at Kubo. So I guess maybe, just to talk a bit more broadly about the financing for tech startups, right? Again, I think the challenge is to create a decent enough kind of funding environment, right, that can be trusted. And the reality is maybe most people will not necessarily have access to like regional funding, right? But if you're a local startup, is there enough early financing available for you to get your ideas off the ground, right? And that this is something that's somewhat inclusive and isn't just available to people that already have Silicon Valley experience or come from, are very lucky to be, maybe related to one of the top 50 families in the country, that type of thing, right? So I guess we've been doing this for some time. I have seen the ecosystem mature quite a bit, so it has improved from the early days. But that being said, it's still very much a tough environment, especially for funding, right? So we've been doing versions of this survey to kind of assess the needs of startups with PwC for a number of years now. The numbers improved a bit. I think it was 88% the first time we did it, and now it's 80% of startup founders we surveyed said that funding was their top hurdle or bottleneck from getting to that next stage, right? And I guess the reality is, as Paul mentioned in his presentation, right, like friends and family or self-funding is still the most common source probably of your first funds, right? You can't expect that maybe to come from an institutional venture capitalist, but the reality is it's not a rich country. The average income is less than the average angel investment required maybe of a startup, right? So it sort of has startups as a rich people thing maybe, which I think is quite unfortunate because a lot of the big problems maybe that have opportunities to be solved aren't necessarily quote first world problems. And in the Philippines in particular, right, I have observed that we are lagging behind even in the region, right, in Southeast Asia in terms of just formal VC funding. Local investors are still risk averse, and maybe you can spend a bit more time talking about this in the panel. But there are lots of I've personally seen a lot of kind of unusual quote unquote deals or structures that aren't necessarily founder friendly or actually make the companies sort of toxic for future institutional funding because it messes up their cap table. But I don't know, right? Obviously, it's not just the investors that are at fault here. There is also a lack maybe of mature founders, definitely very few success stories that we've already seen. And there's sort of a chicken and egg situation, right? But how do we break that cycle, right? So how do we maybe get money, just actual risk capital flowing into companies to get that momentum going, to have enough pipeline, right, of companies that can mature. This is what I would love to discuss today, really. Again, maybe there are lots of competitions already, but how can we look at, bigger grants that are, or just other forms of funding that have fewer strings, or can government fund more funds? Can we have more, education for high net worths? Because the money is there, but maybe not being funneled into startups and companies as much as we'd like. And can we achieve, right, like a genuine attitude change around startups, both as, to have them get more traction and customers, right, like more trust in really patronizing maybe startup companies, and being more introspective about it as an incubator, like what type of support systems can we still do? What do we really need, right, to help the startups overcome these difficulties and make it easier for this whole system to flow a bit better. So yeah, that's kind of my initial thoughts on this topic. But again, very excited to discuss it with the rest of the panel too, on what they think we can do to solve some of the problems.
Thank you, Katrina. That's very. I got startups are a rich people thing. You're solving first world problems. But this is the second time that we've mentioned that money is there, but it's not funneled to where it's supposed to go. So this is a very nice jumping off point for our next panelist, Leah. Leah is the head of Asia Acceleration Programs and the Philippine Country Director of Make Sense. Make Sense is a global incubator that brings together and supports not only engaged citizens and passionate entrepreneurs, but also forward-looking organizations to build and launch their social innovations. What do you think, Leah? Is it can you say about what Katrina said? It's a rich people thing, and we need to have a change in mindset. And what's your take on this?
Actually, Kat, you really made my whole point. So I think you can almost skip my my presentation. But I totally agree with what Kat said. I really want my point of view is really from the perspective of an incubator who focuses on idea stage entrepreneurs in a developing country. And that's really like what Katrina shared is really the reality. Basically, first of all, if you look at when we talk about tech, what do we mean when we talk about tech? At the end, we talk about progress, that we want improvement for the society in terms of mobility, waste management, access to energy, any major issue that we face. And we believe a lot that tech has the power to solve these issues. And we saw many nations evolving thanks to this technological progress. And you see that the countries at the end that invest the most in tech are the most progressive and the most developed one in the world. So it makes sense. When we arrived in the Philippines, so if you compare, for instance, to what makes sense is in France. In France, we have an investment fund, we have an accelerator, we have an incubator, so we are super well developed. So when we arrived in the Philippines, we really looked at, okay, what is the reality of the Philippines? We looked at this entrepreneurial ecosystem, and we saw that there were already incubators, accelerators such as Cubo, Idea Space, Kickstart, Impact Hub, etc., that were already here. There was not so much funding, but you could still maybe look at attracting some funding abroad. But at the end, in our whole analysis, what we really realized is there is a lack of startups. There is a lack of solutions. And as Kat said, there are only few success stories that exist. So for me, the question of funding is really this. It's a chicken and egg situation. Is it the funding that is missing, or is it the solution that is missing? Because at the end, you look at the countries that have the highest rate in terms of investment, etc., are the ones that have a lot of solution, a lot of tech. But at the same time, if you want to have this solution, you need investment to make them go. So with Make Sense, what we decided is really to focus ourselves on, from the perspective of we miss solution. And why do we miss solution? Is because today entrepreneurship is not accessible in developing countries. It's not just the reality of the Philippines, it's the reality of most developing countries. And at the end, the people who have the luxury, because I consider entrepreneurship today a luxury in our context, are the ones who are privileged enough, who can allow themselves to take some financial risk. So from this from this perspective, what we decided to do was to settle an incubator for idea stage entrepreneurs. And the way we're organized as a non-profit. So it means that we have a very philanthropic approach in the way we support our entrepreneurs. So we don't take any equity, any shares whatsoever in the project, but we do provide funding. But when we talk about funding, we talk about more broadly about money, enabling them to have kind of a financial security to start their journey. So what we do is that we provide monthly allowances to our entrepreneurs so they can have at least one person per project to quit their job and focus on the development of their project. Because what you see a lot in the Philippines is that you have a lot of people who start their startups but still have a full-time job on the side. They develop their project on the side, so it's becoming a nightmare to handle. So that's a requirement that we have, which makes sense. And we also sometimes provide smaller grants, small donations, so they can really pilot their solution on the ground. So with Make Sense, our objective is really to help them build their MVP. build a proof of, like the first proof of concept, I won't say the full one, but so they can start really building the whole product. And at the end, when they are like exiting the incubation programs, they can join programs like they can, for instance, go to Cubo or to Idea Space, where they can really help them grow the business and prepare them to really like access their first seed investment, etc., etc. Another approach that we have in like building this whole MVP and enable them to get ready to receive funding is that we work a lot on co-innovation, meaning that we accompany our entrepreneurs by helping them build collaboration with large corporations. So for instance, we supported like social startups that was not tech at all at first, but because they couldn't, like their business model wasn't adapted to grow and scale the number of beneficiaries they could support, we actually brought like a digital aspect to the solution, and we facilitated collaboration with Decathlon. Decathlon, you all know, like the sport retail brand, and basically we made them like build like this online program where for Decathlon that was a way for them to reach more clients, diversify their clients, and for this startup to make evolve their business model so they can reach not at once 20 people but 2,000 at the same time. On the other hand, we do the same thing on the topic of health. We facilitated the collaboration between Sanofi, which is a large pharmaceutical company, and a very young health startups that wanted to really push telemedicine in the Philippines and make it more mainstream. So for us, that's two approaches, that you need to provide like first funding, but more to secure the entrepreneurs. So like there are more people who are starting the journey and are less scared to start this new adventure. But on the other hand, funding goes also through like facilitating this collaboration. So they have a strong proof of concept. And then when they go talk to investors, they feel more reassured in what this project could become in the future. So that's a bit my perspective on things.
All right. Thanks, Leah. That's interesting. You know what I find interesting is that after you nurture them and then they have a viable product, what we found out is they actually go somewhere else, like Singapore, which is a very good place to, it has an enabling environment, really very nice. And this is a very nice continuation to our next speaker, actually. I'd like to ask his opinion about it. Our next panelist is Nitin Pangarkar. He's Associate Professor and Academic Director of the MBA programs of the National University of Singapore, and also the combined MBA program of NUS with Haute Études Commerciales Paris at the NUS. He is an expert on internationalization strategies of firms and on the secret of high-performing companies. We recently conducted a study with Nitin on relocation decisions of tech startups as a strategy to acquire more financing. What do you think, Nitin?
Great. Thank you, Amy. And indeed, we did a study and that was really enjoyable. It was a lot of hard work, but we learned a lot. And as you said, Singapore is a unique environment and it's a magnet in some sense for companies in the region to come here and raise finances. So we might ask why this is so, and has it always been like that? So actually, let me answer the second question first, which is, has it always been like that? Actually not. Singapore was known as a pretty staid place. It was known for manufacturing, attracting large ticket investments like from Esso and Shell and so on, but not really famous for entrepreneurship or venture capital or financing. So they did try a bit, and before they succeeded, they spent a few attempts. So one of the good lessons from that is that the other countries in the region probably will go through the similar sort of cycles. So you need to tweak and twist your strategy before you become successful. Now, Singapore has a good quantum of investments. It is a place where people park their money for whatever reasons, for low tax rate, stable Singapore dollar, etc., etc. But what is interesting in terms of the quantum of investment is the diversity of players, and a couple of those were mentioned earlier. I think Malia, who mentioned a large pharma company funding a small company. So there are many pharma companies in Singapore that are funding small companies, for instance. So that's a very good, the diversity is very, very critical. In Singapore, there are a lot of family offices as in investment vehicles of wealthy families. And what they are looking at is instruments that are beyond the public markets, like the debt or equity markets and so on. So they are open to investing money. So basically, in Singapore, the characteristic is the diversity of funding. And I also did a little bit of comparison between Singapore and other countries, and found that Singapore government over a period of time has arrived at this formula where it doesn't try to do all. And I think that's a mistake that many governments do. That is, they try to do it all. And the government simply cannot replicate either the evaluation systems of the private venture capital or private suppliers of capital, or they cannot replicate the incentives that these private providers of capital do. So government's best role is to provide a conducive environment, and some of the governments in the region are trying too hard to provide the funding themselves. I think that's not the solution. The solution is to provide a conducive environment to attract providers of capital and then let the sort of market magic work its way. And so in terms of providing that conducive environment, you need to have the ease of doing business. So it needs to be really easy to start a business. You need a good infrastructure quality, which is a problem in some big countries like Indonesia, where hinterlands may have infrastructural issues, especially in terms of internet connectivity. You need to have good taxation policies, as Paul was mentioning, because VCs won't come to you, private capital won't come to you if you tax it heavily when it exits. You need to have good immigration policies and so on, so that the talent is attracted. And of course, you need to have good education policies as well. But clearly, government is a facilitator. It cannot do it all. And if the government does a good job of facilitation, I think it is possible for other countries to do it as well. It's a journey. It cannot be done in whatever 1 year or 2 years. Probably it takes a long time. Singapore itself took a long time, but it can be done.
Okay. No, that was clear. We got that. Thank you so much, Nitin. All right. So now is the chance of the audience to participate in the discussions. We have around, let's say 15 minutes for this. I'll kick off with a few questions. We have one clarifying question, actually. But then I would like to hear from the audience. We are having a lot of questions now which are coming in. We will try to answer them as much as we can. Please type your questions in the box and click and thumbs up the questions that you'd like to be answered first. All right. So there's a clarifying question here from Milan, a colleague from area, on the graphs. Can we have the graphs of funding for Cambodia, India, and US seed funding again on the screen, please? So the question is, are the graphs for Cambodia, India, and US seed funding before the equity is raised? Because this is what Winston also said. The personal and family finance, which is a large percentage of the share in the beginning, may shrink dramatically as the startup reaches Series A and beyond. So I'd like to point this to Winston first, please, because you mentioned something about that. And then Paul, if you have something to clarify also on the screen.
Well, I think just on this graph, as I study venture financing quite a bit, as both a hobby and an interest in my business. So I think it's important if we could distinguish just a standard SME versus a venture like SME, right? And if you do that, this graph will start tilting quite a bit. But I think that there are now numerous professional financing mechanism at the very lower entry level now that's coming into the startup scene. And the US is leading that charge with equity crowdfunding, right? That's actually growing dramatically here, seed-in and all the other mechanisms that is enabled by the US government to do small investing into public-like startups in the country has helped quite a bit. So I think that will tilt the balance between money coming from friends and family and shift towards people that are like friends and family but investing professionally through crowdfunding platforms. So I think that's very interesting, and I think that's the model that's actually highly importable by emerging countries from the United States. So I'm actually doing it myself, and I find it to be a much more better fit for as an on-ramp for like the Philippines as an example. But that's a trend that's happening well. I think Singapore did its own variant when the National Research Foundation started with a matching co-investments with VCs to startups that are coming. So I think that's kind of my point on how this might evolve quite a bit. And I think just to kind of also simplify the graphs, I think it would be good to separate the SMEs that will never become a regular startup the way we see it to startups that are bound to be innovation-driven startups. And then you'll see the funding model tilt a little bit as well.
Paul, do you have something to add also to that?
Yeah, no, good points, good question, and good comments by Winston. I'm probably not up to date as on the recent developments in America, and the data I showed is somewhat dated. But my understanding is all the data here in these three graphs are about startups, and they're not about SMEs, traditional SMEs. So I think this is very much focused on startups, but of course, there's always a question of how do you define a startup, you know, and that can be kind of difficult, and that might be part of the reason. But you know, the interesting thing was that I mean, I think Winston may be working at a different level of the economy with the more developed startups than may generally be the case. But we actually went and talked to a lot of startups. And again, it depends which startups you talk to, but we did find there were a lot of very young startups that were actually self-financing things and doing things like one of the other panelists said, like keeping their day job and using that salary to try to keep themselves afloat and to pump it in. So so that might be the case. The thing I always think about is it's not a tech startup, but you know, Nike, the shoe company. I read the biography of Phil Knight, you know, and that company started off by him borrowing $20,000 from his dad. You know, I mean, that's the way a lot of the really small startups really start up. But I think Milan's question is quite interesting because you're right. I mean, we're not differentiating here by the level. This is just lumping everything together. And these and so you might start with some personal finance, family and friends to sort of get things going. But sort of if you really want to scale up, then they need to shift to more institutional forms of finance and so on. So you're right that this needs to be much more differentiated. But I still think there are a lot of startups there. Again, I don't know if you define them as startups that are relying on family and friends to get things going. Thank you.
That's okay. Very good. I have a question for Katrina and Leah before going back to the internationalization topic. We have a really interesting question here. What are your take on how much risk to take for a group of entrepreneurs? And what are the key aspects that you are looking for in startups? Katrina, would you like to begin?
Sure. Could you repeat that question? The level of risk?
Yeah, I mean, how much risk are you going to take when you take on? What are your take on how much risk to take on a group of entrepreneurs?
Maybe I'll try to. I'll take a stab at this question, and maybe I'll combine my response a bit in terms of
Okay.
look for, or I do think that, especially in an environment where there isn't just a lot of money sloshing around, right? Like not a lot of risk capital. A lot of startups, in order for startups to kind of go the distance or even attempt to succeed here, they do need to have a lot of, how do I say this? The team is very important, especially for early stage startups, right? The founders, their attitude, and also just their willingness to kind of act in a startup-y way and to kind of grow their companies. I say this a lot, right? Like investors in this region generally, like very rarely will they invest in just an idea. Like they're looking for traction. They're looking for, it's nice if you have a track record, right? And, you're like Winston here and he's exited 3 times before or something, then that's always a good thing. But especially if it's your first time starting out, it's important that you're not just talking about your idea, but demonstrating that, you are finding product market fit, even if you're doing this in smaller ways, right? But you're making actual progress towards sales, towards building the product, et cetera, et cetera. So in response, right, I would say like a quality that I look for, or that we look for, especially when we're evaluating teams, right, is their ability to execute and hopefully, right, do this, still be able to do this even in a limited funding environment. Because I think, you can't assume that the money is just gonna flow in, right? So in response to your risk question, I really like Leia's approach to this, right? It's important that it's almost like they need to have enough money to at least do this full time, or, be able to quit their jobs, right? But that being said, like, can you run experiments? Can you get that traction and show like proof of it, so that when you do get investment, hopefully, right, then it's just literally kind of adding fuel to the fire and you're ready to go, right? So I hope that sort of responded to your question, but maybe I'll have Leia take a stab at it too.
Okay, thanks, Katrina. Leia, what do you think?
No, I think Kat is totally right, especially at our level. Like, again, we support very, very young entrepreneurs. Most of the time, even like it's an idea most of the time when we take them in. So in a way, we do take a lot of risk. But again, we created a model that allows us to take that risk. And also, I think we were able to really develop like a recruitment process that enable us to limit the risk. So basically, like, so I agree with like all the criteria that Kat said, that you have to focus on the team, on their capacity to work on the project, having a vision, etc., etc. And what we do to make sure that the project that we are taking in, they're actually going to commit to the project. They have all to go through a 6 weeks online program with us, where we need to see in 6 weeks if they were able to at least test one specific aspect of their solution with like very few resources. So we want to test their capacity to build an MVP very quickly and collect inside data on it, and basically testing their whole entrepreneurial posture. And since we implemented this whole process, we used to have like per batch in the Philippines 1 or 2 projects that will quit halfway of the program. And it can be for many reasons. It could be because of family pressure. That's actually something that happens a lot, to go back to the corporate world. It can be because at the end there was not a good match in the team, etc. But basically, since we developed this whole recruitment process that is much more deep, where we spend time with the entrepreneurs trying to understand who they are, how they work, and everything, we are at a success rate around 95%. And just in the last batch, where it started in the middle of the pandemic, everything was online and everything, we had no dropout at all. So I think at the end, because again, the project can evolve anytime, can pivot to any other ideas in the future. But what is important at the end of the day is the people in developing the solution.
Thank you, Leia. Yes, Katrina.
Very briefly. Just, I think when you're thinking about startups also, like there are different types of funding. Like there are some startup ideas that are never going to be like for venture capital financing, right? So it's about matching the type of financing available to the types of projects you also want to nurture. Because like I remembered something from the earlier question, right? Like when you're looking for a startup that's viable to really get venture funding, right? Then the idea and even the market itself from the get-go has to be big enough. But that's not going to be true for all startups. So I think finding the right fit between the mode of funding, the bite size, right, and what this company needs to succeed, like the fit there really has to exist, right? So anyway, I just wanted to put that out there as well.
No, good point, good point. Some will not really be viable. Some will not internationalize, actually. And that's my next question. It's the most approved question here. How important is internationalization as a strategy for tech startup expansion? There are language barriers in Asia, and countries have weak enabling environments. How realistic will it be as a success strategy? Should we still encourage startups for internationalization, considering that some of them are really not going to make it? Nitin, what can you think?
Yeah, I think like anything else, internationalization will have cost and benefits, and that cost benefit equation would vary. Now, in terms of language, the effect of language would be different across different contexts. So, for instance, if you have an edtech startup, I think the language may be quite important, Whereas for a health tech startup, the language may be less important, but the kind of healthcare setup you have in terms of what kind of hospitals, who funds it, may be more important. So I think language is one of the barriers, but that need not be the biggest barrier, or need not be the most salient barrier. In fact, I met a Malaysian startup which said that to sell to Malaysian hospitals, they would need layers of approvals, and they had to make multiple presentations. But they said that the Singapore, they found it easier to sell because Singapore has very few hospitals, like very few large hospitals, and you make a pitch to one, you convince one, you carry that reference case to another. So I think internationalization in general, I'm a big fan of it. I think it's good. Of course, in specific instances, the cost may outweigh, but the barriers can be overcome. I think, again, that's what startups are about, overcoming barriers. So they can be overcome if you can do it successfully. There are lots of rewards.
Thanks. All right. So we are having just a couple of minutes left. I just would like to make one final round among all of the panelists. What are your final thoughts on financing of tech startups in Asia? And share us your final words to the audience. We have a lot of questions still. I'm really very sorry, but we don't have time. Final thoughts of everybody. I'll start with Paul, and then we'll go through each of the panelists first. Okay.
Final thoughts. I don't have really a lot. I think it's just a very complex issue, and I've tried to simplify it. Maybe I tried to simplify it a bit too much, but I think a lot of the issues that came up were very interesting. And I think also, this question, is it finance? Is it the finance availability, or is it getting the startups to come forward, the people that have ideas? I think that's a very good discussion and distinction. And we shouldn't lose sight of the fact that we need startups to come forward. It doesn't matter if the funding is there or not. If they don't come forward, we're not moving forward. So some of the excellent work that Leah is doing, I think is really interesting in that regard. Thank you.
Thanks, Paul. Winston.
Yeah, so to me, I think the one thing that I can share from my personal research these days is that, people want to invest in something they're familiar with. And one of the areas that is really interesting to think about is the role of the diaspora in terms of financing. So while you look at the Philippines, for instance, is having generally, average GDP is not that high, the Filipinos around the world, the global Filipinos, actually have financial capability. And if we could somehow marshal that financial capability into a directed, investment into Filipino innovation, there might be something there. So I think, to me, the research that I'm personally doing is, how do you tap onto those? How do you organize that diaspora capital? And then how do you repatriate them back to the country, both in terms of skill set and money, is something to think about when we think about, enabling startups.
Good point. Yeah.
Thank you. Katrina?
Yeah, I mean, it's a tough question, right? Like, I guess if for the startup founders out there, it's it's really hard to get funded. So don't take it personally, I guess, or don't lose hope. But I guess on a more serious note, I think there is still a lot of work that needs to be done, right, on maybe the enablers and to get the startups ready, but also to really, again, have that right type of funding, right? It seems like the money is there, but really, how do we lower the hurdles and be able to match, right, the capital with the founders, and hopefully create this snowball effect, right, to catalyze larger investments that can in turn lead to bigger companies that have the resources they need to scale. This is really the big question, right, that we all have to kind of try to answer as a group. We're working on it, but obviously there's still a long way to go, right, between where we are, what we're actually seeing on the ground here in places like the Philippines, right, versus what you're seeing in the US, right? So again, still lots more to think about, but from what I'm seeing, I'm very confident about there is that desire there. There are founders, there are ideas, there are startups, and I guess our task is to make sure that they have the resources they need to succeed. So let's go for it.
Very good. Leah?
Yeah, I totally agree with all of this. For me, like, definitely we have to see how, like, the investors can take more risk, but we don't know yet when it's going to happen. And like, that's for me another question that we need to solve. And in the meantime, for the entrepreneurs who are like building their project, we need to see like they need to ask themselves the question, okay, if I can't access funding in through the classic way, how can I innovate about my funding? And I think there are different approach. I definitely agree with what Winston mentioned about the diaspora. When you look at the Filipino diaspora, for instance, in the US, there is a very strong community who is really in a logic of giving back, and who is not just in a logic of like having the charity mindset of I'm just making a donation to build a school, who are really in logic of investing in the Philippines and who want to see the Philippines growing. But you have also other groups. You have for instance, for women entrepreneurs, you have more and more groups. And I've seen, for instance, one startup that we've been supporting here in the Philippines that address a woman health issue. And talking about women's health and reproductive health is quite something as a taboo here. So what we did is we started to explore where in the world people are okay to talk maybe about this topic, who are ready to invest in such projects. And we looked at, for instance, Europe, the US. So that's also another perspective, that maybe internationalization is not necessarily about you going to another market, but maybe looking for funding who already exists for such project in other market and trying to bring this to Asia or the Philippines. And of course, my last thing, and that's something that we've been doing for quite a long time now, is definitely co-innovation. For me, there is a lot of opportunities, and we are only at the beginning of this ecosystem in Asia, and there is a lot to do, and cooperation wants to go into this, so it's very exciting also.
Indeed, it's a very exciting time. We have come to the end of our schedule, and it was a rich and fruitful discussion. I wish we could have discussed more. I'd like to thank our distinguished presenter, Paul, and our distinguished panelists, Leah, Katrina, Nitin, and Winston, for sharing their precious time and insights for this timely and relevant topic. The next Asian Impact webinar will be about new ways to measure women's work and empowerment, to be held on the 23rd of March from 9:30 in the morning to 10:30 Manila time. This will be hosted by Samantha Hung Chief of ADB's Gender Equity Group with our very own Joe Sveglich and Keiko Novaka. In this AIW, the authors will try to answer what are the new ways to measure women's work and empowerment, and what are the implications for pandemic recovery efforts. Once again, thank you for joining us this afternoon. Goodbye and see you next time.